you're probably leaving 11 grand on the table every single year. And if you get it wrong, HMRC can come back 6 years and slap penalties on top. Most LTD directors think expensing means throwing everything through the business. New laptop, coffee, that trip to Edinburgh, the gym, some of that's completely fine. Some of it will blindside you with a tax bill you didn't see coming. The thing is, you're not trying to be dodgy. HMRC's rules are just genuinely murky, and most accountants don't explain them until you've already messed it up. Look at the numbers. Right now, there are 4.2 million limited companies registered in the UK. A huge chunk of them, especially ones set up by freelancers and contractors on 30 to 45k, are getting this wrong every month. Text overlay: 4.2 million LTD companies in the UK, 2025. You set up a LTD to keep more of what you earn. Corporation tax sits at 25% for profits above 250,000. For most small company directors, it's still 19% on the small profits rate. That gap between your corporation tax and your personal income tax, that's where the real money is. Expenses cut your taxable profit. Get them right, and you're legally keeping money HMRC would have taken. Text overlay: every £1,000 of legitimate expenses equals £190, 250 back in your pocket. Mess them up: benefit in kind charge, P11D filing, a tax bill that wipes out everything you thought you'd saved. Let me show you exactly where the line sits. There's one rule that changes everything. We'll get to it. But first, you need to know the mistake almost every new director makes in year one. Solution Section 1: the wholly and exclusively rule. HMRC has one core test for any business expense. 4 words: wholly and exclusively for the purposes of the trade. That's it. If an expense is wholly and exclusively for your business, it's in. If it has any personal angle at all, you're in murky water. Take a laptop. If you buy it for work and only use it for work, sorted. The second it becomes the family film machine on Sunday night, HMRC's going to push back. Dual purpose means either no deduction or one they'll fight you on. The one real exception is a home office. You can claim a slice of your household bills, broadband, electricity, even part of rent or mortgage interest. HMRC will take £6 per week flat rate with no receipts. Want to claim the real figure? Work out what percentage of your home is actually work only and apply that to your actual bills. Text overlay: HMRC flat rate home office, £6 week, or use actual cost method. Solution Section 2: what you actually can expense. Let's go through what actually sticks. Travel is massive. Use your own car for business trips and your LTD pays you 45 pence per mile for the first 10,000 miles, then 25 pence after. That money lands in your hands tax-free. The company gets the deduction. HMRC doesn't question proper mileage logs. Training's another win people sleep on. If you take a course that builds a skill your business actually uses right now, that's allowable. Web developer doing advanced JavaScript, consultant doing project management. Clean, straightforward. The word that matters is current. HMRC won't touch a course that's really about switching careers. That's personal development. It doesn't fit the wholly and exclusively test. Solution Section 3: the gray areas that catch people out. This is where people get hammered. Entertaining, meals out, drinks. Client entertaining, taking clients to lunch, buying them tickets, picking up the tab, is absolutely not deductible for corporation tax. You can put it through the business, sure, your bank balance changes, but HMRC adds it back when they work out your taxable profit. You get zero tax relief. Text overlay, client entertaining, not deductible for corporation tax. The only exception is staff entertaining. You get £150 per head per year for genuine staff events. Christmas party, summer do, that works. You need at least 2 employees to use it though. Solo director with no staff, you can't claim this for yourself. And the phone, 1 mobile, 1 contract, paid by the company, completely fine. Tax-free benefit in kind. 2 phones and HMRC will want to know why. Have your answer ready. Solution Section 4, Directors' Loans and the mistake that creates a tax nightmare. This one blindsides people. You're skint. You pull money out of the company account. You tell yourself you'll put it back. 6 months later, you've forgotten it's even there. That's a director's loan. If it's still sitting there 9 months after your year end, HMRC hits you with Section 455. That's 33.75% of whatever you owe them, straight away. Text overlay, Section 455 tax equals 33.75% of outstanding director's loan after 9 months. You get the tax back when you repay the loan, but you've lent HMRC your own money for free in the meantime, and if that loan gets written off, it becomes income in your hands, taxed at your rate, plus NI. This is not a loophole, it's a trap. But honestly, the rules aren't why people get this wrong. It's the mindset. When you set up a LTD, something shifts. The company account starts to feel like an extension of your personal wallet. That feeling is dangerous. The directors who breeze through HMRC inquiries aren't the ones who have memorized the tax code. They're the ones who kept proper records from day one, who asked themselves, would I be comfortable showing HMRC this before approving anything? That 2-second check is worth thousands over the life of your company. Data Phase 2, the action plan. Right, here's what you actually do. The P11D trips people up badly. If you've given yourself anything through the company, private health insurance, a company car, even a loan over £10,000, you've got to report it on a P11D by the 6th of July after the tax year ends. Miss it, and the fine starts at £300 per form per year. Text overlay, P11D deadline, 6 July 2025. Fine for missing it, £300 per form. And here's what most people completely miss. Annual investment allowance. Your company can deduct £1 million of capital spending in the year you buy it. Computers, equipment, tools, full deduction in year 1, not split across years. Gone. That's HMRC approved. Use it. Proof plus FCA compliance. Receipt, GOV UK page showing the wholly and exclusively test under CTA 2009 S54 with the phrase highlighted in yellow. This all comes straight from HMRC Section 54 of the Corporation Tax Act 2009. The P11D guide, the mileage rates table, it's all public. Here's the thing though, HMRC's rules do shift. Section 455 rates change. Benefits in kind rates move every April. What your accountant said 3 years ago might be outdated. Check GOV UK, check it every year. Do this today, log into your company bank, pull the last 3 months, go through each transaction and ask, does this pass the wholly and exclusively test? Could I show HMRC a receipt right now? If the answer's no to either, fix it before year end, not after. If you're trying to figure out how to pay yourself tax efficiently from your company, salary versus dividends versus pension contributions, I broke down the exact numbers for 2025/26 in the next video. The link is on screen. What we covered here changes how you structure all of that. This video is for educational purposes only and does not constitute financial advice. Always do your own research or speak to an FCA-regulated advisor before making any financial decisions.